If there are things that are additive to EBITDA, if you're not getting a sell side quality of earnings, you may not uncover those sort of things. It's a good dry run to what the buy side QoE is going to look like. It gives you practice. It's a prep with a friendly party. Mm-hmm. It helps for a faster close. It makes all of the offers that come in before, pre-LOI more informed and less likely to have purchase price adjustments. There's just a lot of benefits of doing that. And over the past 10 years, I would say we're seeing it a lot more.
Welcome to M&A Insights. Today's episode is all about what every MSP owner needs to know before going to market. I'm joined by Dan Brumwell, partner at Weaver's transaction advisory practice. Dan breaks down how quality of earnings and net working capital analyses can make or break your deal. If you want to defend your valuation and avoid last-minute surprises, this one's for you. But here's what's really surprising. Financial due diligence is not just a buyer's ask anymore. More and more sellers are getting their own due diligence done to understand their numbers, control their narrative, and be prepared for the buyer's due diligence. More control, better information means a better exit with fewer surprises. Listen in. But first, let's get some housekeeping out of the way. My name is Madhur Dugar. I am a senior M&A advisor at Exendio Advisors, focused around MSPs and IT services. And this is my podcast series, M&A Insights. If you are interested in finding out more about how we are helping MSPs exit or grow inorganically, write to me at madhur@exendio.com, connect with me over LinkedIn, or visit our website, www.exendio.com. Let's get started.
Dan, welcome to my podcast. Really appreciate you're joining us for what is a really important topic.
Yeah, thank you. I'm very glad and excited to be here, Madhur.
Yeah, same here. I mean, financial due diligence is such a big theme in the whole M&A process. And I know you guys spend a lot of time thinking about it and helping out your clients with that. So really wanted to get that sort of content and insight as part of my podcast. Tell us a little bit about yourself, Dan, and tell us a little bit about Weaver and kind of how you're supporting clients in the MSP space or the broader IT services space with some of the things you guys do.
Yeah, so I'm a partner at Weaver in the transaction advisory group. Weaver's a top 30 firm. I started my career in audit at a Big Four firm, did that for a while, transitioned to a different Big Four firm, doing transaction advisory there, and eventually made my way over here to Weaver. When I got here at Weaver, our transactions group was 3 to 4 professionals. And that was in 2018. And since 2018, we've grown the group to about 20 in the US. And we also have a team of 8 in India that support us and help us. So I do both buy side and sell side QoEs. And so kind of got experience on both sides of the table there.
Yeah. If folks wanted to reach you, where can they reach you?
Yeah. I'd encourage connect with me on LinkedIn. Also, my our Weaver website has my bio and profile there, and some contact information there. So that's another great place to connect with me.
Thanks a lot. And for those of us who are listening to this and are curious about how they might reach me, maybe to get a version of this recording or any other follow-up questions, I'm at Exendio Advisors in the M&A space. We work with MSPs a lot, and IT services companies in general. You can reach me at Madhur, that's MADHUR, at Exendio, EXCENDIO.com, or just connect with me on LinkedIn. Let's get started. Let's just start with what is financial due diligence and what is a quality of earnings report? Can you help us understand that a little bit?
Yeah, so it's very basic level. Financial due diligence it's an exercise that buyers go through prior to executing an M&A transaction. So quality of earnings is one diligent stream of many. And really our focus in the QoE space is what is adjusted EBITDA? We use adjusted EBITDA as kind of a proxy for cash flow. It helps the investor know how much cash is this business generating. And ultimately that EBITDA figure helps determine the purchase price.
Yeah. And in the M&A process, like at what stage does this analysis kick in?
Yeah, so we are pretty early in the process. So there's really two different ways to think about this. We have buy side work and sell side work. On the buy side, we're going to come in very shortly after the LOI. So there's been an agreement, a tentative purchase price has been agreed upon. Now we're going to bring in the accounting folks to determine is the EBITDA that's been presented fair and accurate. And so that's kind of our goal there. I like to compare obtaining a quality of earnings report similar to kind of the home inspection process when you're going through the home purchase process. So after you go under contract with the seller, you typically engage, a home inspection with the goal being to make sure that you're not inheriting any large problems, a bad roof, et cetera. So the goal is very similar on the QoE side. We're here to make sure that you know what risks there are and the cash flow is in a range that you think it is. And that there's just trying to minimize the amount of surprises that can come up in a transaction process.
Yeah. And we'll go into like more of the details as we go through this podcast, but what are some of the core components of a QoE report and what should MSP owners expect in order to see in one company?
Yeah. So the core components of a QoE report are largely going to be the same across all different industries. We always start by trying to get the most granular level data possible. So think trial balances, general ledgers, and we're going to do this for each and every entity that's involved in the transaction. So we're going to start kind of a ground up approach, and we're going to build some financial statements and a large deck of information in Excel. We're going to reconcile cash collections to the revenue that you're showing in your financial statements. We call that exercise a cash proof. That's a pretty key component. The exercise it's rarely as straightforward as it sounds because you have to account for changes in accounts receivable and sales taxes and a whole host of other things that can lead to differences between your bank revenue and book revenue. But as I mentioned earlier, kind of the primary focus here is adjusted EBITDA. A lot of our work is going to center around adjustments to EBITDA. And as I mentioned, that's because EBITDA really ends up being kind of that best proxy for cash flow to value a company off of. Specifically in regards to MSPs, I think some of the metrics that we like to highlight revolve around recurring revenue, customer churn, really understanding gross margin, and among other analysis. A lot of the buyers that we see really want to see where the different sources of revenue are coming from. How much is it project-based versus true recurring kind of contractual-based revenue? So recurring revenue is, I'm sure you can attest, is kind of investors' favorite type of revenue when it comes to MSPs. So the more revenue you have in that bucket, generally, the more favorable that's looked upon. So,
Dan, just a bit of a side note, but out of curiosity. So let's say a company has recurring revenue, but within recurring revenue also, you can have month-to-month type recurring revenues. You can have annual contract recurring revenues. You can have 3-year recurring revenues. Like, do you break that down? Like, do buyers really ask for that type of detail? Do you provide it, or how does that work?
Yeah, absolutely. And, we see a lot of smaller MSPs, they'll record things on a cash basis. So if you have an annual renewal, you may have a large jump in revenue in 1 month, but really GAAP says you need to spread that revenue out over the life of the service period. So that's something that we are keenly focused in on, making sure that we understand, the payment terms of each customer and when that revenue should be recognized.
So that's interesting, right? Because in order for you to look at a number and say whether this is a month-to-month contract or a 1-year contract or a 3-year contract, you need to understand the payment terms of the underlying contract, which means that now you need to look not just at the numbers, but also what the contract type is, right?
Yep.
So then that gets into, hey, what is the quality of information that is available at the seller in terms of providing this information to you, or do you have to dig it out from them through multiple conversations? I mean, is that a reasonable concern that I'm having, that this could be like a more drawn out affair because this information is not easily available?
Yeah, no, we see across the spectrum. Some MSPs have it buttoned up. They have spreadsheets that show, yeah, this is a 3-month renewal, whereas others, there's no data on it, and we've got to come up with some creative way to figure out. We have 1,000 customers. How do we know which ones are renewing on what basis? So there's a lot of art to this as well.
Absolutely. And kind of along the same lines in terms of the R stuff, like there is a huge, buyers would really like to get it down to like profitability per customer. It's not just the revenue per customer, but how much gross margin are they making per customer? How much is the EBITDA per customer if they could get it down to that level, right? Does a QoE report provide insight into that or allow them a way to get to that, or no?
And it depends. So it depends really on the client's their diligence and record keeping prior to coming into the transaction. And so a lot of times we're recommending that people, you may be thinking of selling your business in a year or two, but go out now and kind of get a feel for what a sell side quality of earnings may look like. I don't think there's no disadvantage to starting that process a little bit earlier. It allows to give you time if there are some gaps to really kind of clean up the accounting and get things in order and ready for a buyer when you are ready to go to market.
It's so interesting you're saying this, because literally before this recording, I got off a phone call with a client who had told me, listen, go ahead and access my QuickBooks and download my information because I'm helping them out with straightening out their financials. And I said to them, no, why don't you join me on the call and you walk me through what your QuickBooks looks like? Because I had a funny feeling, and sure enough, by the end of the call, he was like, oh, you know what? Let me download this stuff because there's stuff that is missing in this view that I need to add back in there before I get back to you and let you, download this information. So goes back to this comment about, how the quality of information is really available and that really driving so much of this analysis. And frankly, like, unless a seller does this beforehand, they'll never really acknowledge what the gaps are or holes are in their numbers. So I appreciate your sharing that with us. What's the difference between audited financial statements and a QoE report?
Yeah, good question. I mean, an audit is really going to focus around the end of year figures, whereas the quality of earnings, we're focusing on a 12-month picture. So that's one key difference. An audit is going to have a lot more like granular level testing, pulling invoices. QoE, there's a little bit less of that. And we do pull invoices on occasion. If you have some legal spend that you're telling me is one time, it's not going to happen again, we may ask for an invoice or something to kind of validate that assertion there. But an audit also isn't going to give an opinion on one-time non-recurring expenses, whereas a QoE, we're going to take a position that, hey, this type of expense, like that legal expense that I was just describing, it's, it may not continue in the future, or it's not going to continue in the future. And so we'll position the report in such a way so that an investor knows that they don't need to plan on that level of legal spend in the future.
That opinion that you gave, that this is their one time or not a one time, is that like separately laid out, or is it implicit in the way you've analyzed the company?
Yeah, so the quality of earnings table will start at, here's what net income and EBITDA is right off your books, as if there were no changes. And then we're going to walk through individually and say, all right, here's one adjustment that we're making to the financial statements for a one-time item. And we're going to have a narrative and justify our reasons why we believe that this is one time and why management has asserted that it is such. Yeah. And ultimately we come down to that adjusted EBITDA figure that investors really care about.
Yeah. All right. Let's talk about the adjustments. What are some of the typical adjustments that are made in a QoE report for MSPs? We hear about owner compensation, one-time expenses, but tell us.
Yeah. So certainly one common adjustment is owner's comp. So, sometimes you'll see owner not compensating themselves very much, or sometimes you see it on the complete other end of the spectrum. What we're going to do is we're going to take out owner's comp, and then depending on what our target audience for the QoE is, we'll layer in an estimated go forward comp expectation. And that difference is either an add back or a deduct from EBITDA.
Mm-hmm.
So that's a very common one. The other ones I see, especially with MSPs, revolve around deferred revenue, like we talked about before. A lot of, especially smaller MSPs, are recording revenue on a cash basis. We're going to actually say, okay, yeah, they paid you, $120,000 for a year subscription, but they've only been active for 3 months, and that other 9 months of revenue is going to be deferred. And so that's a very common adjustment that we see for MSPs.
Okay. So it hopefully when you do that kind of an adjustment, it actually makes the statements a little bit smoother to look at, because you sort of spread out a one-time payment over a period of time, right? Yeah. Okay.
Yeah, it helps. It certainly helps give an investor an understanding of when you're actually performing the work versus when just the cash is collection. And usually, you see a financial statements that look a lot more smooth, a lot more normalized.
Yeah.
Right. All right. Just a couple more things on this. Let's talk about synergies for a second. Synergies that the buyer is anticipating they're going to get on this front. Do they make it as part of the adjustment, or they are separate?
Yeah. If I think, when we're going to market, if you tell me, Matter, that we're primarily looking at strategic buyers, we may definitely position the QoE in light of what a strategic buyer, the synergies a strategic buyer may be likely to achieve. So if there's some accounting synergies, we'll do that. And so, yeah, it certainly depends on the audience, but we're going to be thinking about synergies.
So this is a case where a seller, which has engaged with you to do a financial due diligence report, and you're doing it from their perspective, right, might have an interest in having you do that view so that a prospective buyer might be able to look at it that way, right? But
yep.
Right.
And even on the buy side, we'll be thinking about synergies with our current client. If we know if this is an add-on to a platform and we know they've already got an accounting structure in place, there may be some synergies in that space. And we're going to look at all of the different costs and expenditures. But
okay, another item on this one, like most when you look at most founders of smaller MSPs in particular, and they report a gross profit line, right? That gross profit line has revenues, it has cost of goods sold, but that cost of goods sold is typically the cost of the software they're using to provide, to provide to their clients. But they often do not have like the cost of the L1 technician or the L2 technician, or, the sales engineer, or the relationship manager who is managing the account on a regular basis, which is basically a regular cost. Like, would you make those adjustments to get to a adjusted gross profit number, or would you not?
Yeah. So one of our exercises is we get third party. If you're using, say, ADP for your payroll, we're going to get a payroll listing that shows all of your employees, what you paid them, what you bonus them, et cetera. And we're going to try to match that up with their job category. And we will reclassify employees that are more cost of goods sold or cost of sales in nature up into cost of sales, so that our gross margin picture is more indicative of what the market looks like for that.
I appreciate you sharing that. A lot of founders come to me and say, oh, I've got a 70% gross profit margin. And I'm like, no, you don't, because it's probably because you haven't included those costs in there. Like the industry average for, managed services is probably more like in the high 40s or, maybe in the low 50s. So I think it's important for them to understand what the true cost of running that business is. Okay. When you're looking at recurring revenues, right? I always have this debate with people about what is truly recurring revenue versus reoccurring revenue, So it's in the contract or it's not in the contract, but happens to happen often enough, right? Do you think about those aspects? Do you delineate them in your analysis?
Yeah, sometimes we certainly will if the data is available. Kind of how I think about recurring revenue is that's that monthly subscription fee type of scenario. Reoccurring revenue, maybe an add-on or a short project on top of that that is very regular and seemingly consistent. So we do try to separate that out. we're going to leverage the company's accounting system like QuickBooks, or if they use another payment system like Stripe or something, we may try to get some of that data. And we're going to look at trends, retention among those recurring customers.
Right.
We may get into this later, but we do also look at gross versus net churn sometime. And so we're really just trying to think like an investor when we do the QoE and present the quality of earnings report in a way that makes sense to the market.
Yeah. So gross churn being on your existing customers, what percentage of customers did you lose, for example, and net churn being after taking into account any additional customers you might have added to your existing set of customers. Is that right? How you think about gross and net?
Yeah. One distinction on the net retention, we don't typically put in new customers there. Okay. We're putting in upsells among existing customers into that calculation.
Yeah.
But again, a lot of this, like I said, it's more of an art than a science. Yeah. And if we know that our client is used to including new customers into that calculation, we're going to tailor it to what makes most sense for them.
Yeah. What are some red flags that you find in MSP financials, or even more generally during the QoE process?
Yeah. So one major red flag would be we're just not able to reconcile your bank cash to what you're showing in the financial statements. That's if we can't do that, that's going to really be kind of a full stop on a deal. Mm-hmm. So that's kind of a gating item, I would say, as a red flag. Mm-hmm. But other things, I mean, we see people a lot of times be really aggressive with accounting estimates. Mm-hmm. I do a lot of other work in like construction percentage of completion accounting. You don't really see that in the MSP space, but there's a lot of accounting estimates that you have to make. And if you're really aggressive on those estimates, it can really distort earnings. Yeah. And so just looking for those areas where there's judgment and seeing, all right, are they trying to be aggressive? Are they trying to be a little bit more conservative here?
There's a big trend in the market right now where, let's call it $3, $4, $5 million MSPs are looking to buy $1, $2 million MSPs. And I know that one of the red flags that they're going to run into every time they try to buy a $1 million MSP is they're going to try to reconcile, the cash statements at the bank accounts with the invoices and receipts and payments that you pick out of QuickBooks that they might not reconcile. And that's not because somebody's trying to pull a fast one. It's just because maybe they haven't done it properly or completely. So some things are still sitting in a PDF, haven't made it into the QuickBooks. And so you have to really account for those things when you're trying to think about integrating a smaller company and account for the fact that it's going to take you time and money and, to work through those issues. So just the operational hazards of that have to be thought through. Let's talk about net working capital. Really interesting topic. And also, I think part of that whole financial due diligence packet, right?
What is net working capital in very simple terms, and why is it critical for M&A transactions?
Yeah. So at its most basic level, net working capital is just, your current assets minus your current liabilities. When we talk about net working capital, though, in terms of an M&A transaction, that concept is often defined in the purchase agreement. So an analogy that I heard that I think is really useful is, when you go to buy a car and you drive off the lot, you're expecting to have a full tank of gas with the car. So very similar when someone comes to buy a business, when the keys are turned over to the business, they expect to have that full tank of gas, so to speak, which is a certain amount of net working capital to keep the business running without having to draw upon a line of credit or some other cash injection immediately after close. So I think thinking about it in terms of that, it can get really subjective, though. Like, what is a full tank of gas? Yeah. That's a very subjective thing. The seller may say it's, $500,000 that's the net working capital that's required to run the business, where the buyer is probably going to say something like, no, I think it's more like $1 million or $1.5 million. So there's a lot of jockeying back and forth on that.
And I think the reason why the jockeying happens is because the purchase price that has been agreed upon includes in it, in each person's mind, a certain amount of money that's going to be sitting in that bank account as cash, right? And
Yep.
so it's in the buyer's interest to have much more of it sitting in terms of cash, and so that he can, because cash is king, cash is cash, cash is in your hand right now. So I think that's where that comes from. But how was it even calculated at a high level?
Yeah. So to kind of just keep it simple, let's say both parties agree that this full tank of gas or this net working capital target is going to be $1 million. Generally, the buyer will have 90 days after close to calculate how much net working capital they delivered as of the date of close. So let's say when they do the calculation, they come back and say, okay, well, the seller actually delivered 1.2 million of net working capital. They delivered more than that full tank of gas. Then $200,000 would be returned to the seller. Similarly, if there was a shortfall there, the seller is going to have to return some money to the buyer.
What is a typical amount of net working capital that buyers ask for? It's like 6 months, 1 year's worth of tank.
Yeah. Usually what I see most often, and this can vary from industry and company, but usually it's a trailing 12-month average. So we're going to look at the average net working capital after we make a few adjustments that kind of line up with the QoE. We're going to say, all right, 12-month average is going to be our target, and we're going to compare against that figure. Now, if the business is highly seasonal or it's in super high growth mode, we may see a different look back. We may see a 3-month look back or a 6-month look back. So it's subjective and it's very deal by deal. And I think this is an area that, working with an advisor is it's wise to do so.
Look, you can have net working capital in the form of accounts receivable. You can have net working capital in the form of cash. In your gas example, that's like, regular gas and super unleaded gas, right? Have you seen situations where people have had issues in terms of, okay, what is the mix of this net working capital, and I don't like the mix that's been given to me?
Yeah, so I'd say 95% of transactions that I see are going to be cash-free and debt-free. So that cash is already totally excluded from the calculation of net working capital. Whatever cash the business owner has decided to keep on their balance sheet, they take with them at close. That's typically what I see. But yeah, the makeup of the other parts of accounts or of current assets and current liabilities can be important. So if you have a lot of prepaid, maybe I prepaid for this expensive software that, it's a 2-year license or something, the makeup of it is important. Accounts receivable is an immediate cash benefits, in theory. So
are there some common pitfalls and misunderstandings that sellers have about net working capital that might cause them to get disgruntled at closing?
Yeah. So as I mentioned before, most of our transactions that we see are cash-free, debt-free. And so one important aspect, I guess this maybe kind of goes into why do we even have this mechanism in the first place, is really it's the buyer wants some assurity that the seller isn't going to strip the company of all of its working capital right before close. So you could think of an extreme example where the buyer or the seller knows that he or she's going to keep the cash post-transaction. And so they call all of their customers and say, hey, why don't you pay me early? I'll give you a 75% discount. As long as you're paying me right before close, I know that I'm going to get this cash and take it with me. And when the buyer jumps into the business, all of a sudden they have no accounts receivable because the cash and the AR is gone. So that's one thing that I think is helpful to understand. I think another misunderstanding sometimes that I do see is sometimes sellers think that they're going to get paid for the AR that's outstanding.
I see. Okay.
And that's not really the case either. Right. You are getting paid for it through the EBITDA multiple, but you're not going to get dollar for dollar in a normal transaction the value of that accounts receivable.
Agreed. That's a good point for people to remember. The purchase price, which is expressed as a multiple of your EBITDA, includes in it whatever is there in your balance sheet, including your accounts receivable. I want to talk about process and client communication because this has got to be so important, especially for the smaller transactions. Help us understand what does a typical process look like right from the time that you've been engaged, and then you start collecting the data all the way to the end of the analysis and submission of the report?
Yeah. So typical process, as I mentioned earlier, we're trying to start with really granular level data. So typically the first week or so of the quality of earnings engagement is going to be gathering data. We're going to ask for a QuickBooks backup if you're using QuickBooks. We're just going to try to get as much data as we can. And then the next step is generally we're going to hold a 4 to 5 hour meeting with whoever's in charge of the accounting and the owner typically. So we like to break that meeting into 2 sessions because 4 to 5 hours is a long time to be on a Zoom call. But that meeting is going to be really a fact-finding mission for us. We're going to ask a lot of questions. We're going to take a ton of notes. But ultimately from there, that's going to be kind of the springboard to make the adjustments and to have a basis and rationale that we can defend in the marketplace to come down to adjusted EBITDA. So all in, I would say probably it's a 4 to 5 week process on the sell side. Yeah. It can stretch a little bit longer if there's really complex, nuanced things, but that's probably a good average.
And then this occurs within the overall due diligence that's going on, right? So, so when we think about due diligence as being, I don't know, like a 2 to 3 month process, a good chunk of that, right, is you're doing other things during due diligence. One of the things you're doing is getting your financial due diligence guy to run their analysis on the company. When you are speaking with the seller, trying to understand the business, trying to understand the numbers, what is a good representation from the sellers that makes your life easy? Like if it's the founder, or is it a group of other people along with the founder who are having their call with you?
Yeah, it's generally the founder and generally the controller or CFO, whoever they have in charge of their accounting. A lot of times, though, we're brought in at very early stage, and there's not a lot of people at the company that even know that the founder is thinking about this. Yeah. So that's one complexity that we navigate through. And, if the founder doesn't want to let their CFO know that this is happening, sometimes we're just auditors. We can kind of play the part to help the founder get the information he or she needs to make a decision if they want to go through with the transaction.
This is also interesting. I completely agree with you. Founders will often be in this position where they don't want to necessarily share what this conversation with people who really know the numbers and spend their time doing them. But then that means that the information that they share with you becomes a little bit less complete, right? Because it gives less of a view, and that's a challenge that you have to work with on your side. Well, I guess that's part of something that makes it challenging and complex is just gathering the data, understanding the data, given that the person who's explaining it to you might not fully have their hands around it, right? Other things you think are worth noting, or are those sort of the main pieces?
Yeah, no, that's a good point. I mean, sometimes we see, hey, my CPA made that entry. I really don't know why. So if we can loop in the CPA, we will. But we're getting so much information in kind of the initial phases. We're able to go through and sometimes retrace the journal entries and kind of figure it out ourselves because we have a lot of experience in this space, and we just have a lot of data at our fingertips that we ask for up front. So we actually use a tool a lot of time to automatically extract a significant portion of this data so that we're not going back and forth with the seller. Like, hey, you pulled the right report, but the dates are wrong. There's just a lot of back and forth that can occur, and this makes it simple.
Make it simple. So you have a tool that integrates with common, I guess, bookkeeping tools and to get that information out, which also means that for sellers, the one thing they have to get comfortable with is allowing people to have access to that information, because without that, you're not going to be able to do your analysis.
Exactly.
So it's either that or be prepared to basically be asked 15 questions a day for a period of time, to get them this and get them that. Have you come across situations where it's just difficult to pry information out of the founder on the other side?
I would say that occurs more often when we're on the buy side. Sometimes there can be a little caginess, but we're pretty good at working with them and getting creative. Sometimes the data that we're asking for simply just isn't there.
Yeah.
It isn't available. And so sometimes it is an exercise of just putting our heads together with the controller and figuring out a creative solution to the problem. So
look, in my prior life as an M&A banker, we had many situations where we had to deal with just really tight deadlines that suddenly came upon us, and we had to complete 3 weeks worth of work in 5 days. And I have hazy memories of those 5 days. But do you have similar situations that occur for you where the deadlines suddenly get really tight, maybe because they're trying to finish something deal needs to get done by a certain point in time, maybe by in a year or something?
Yeah, definitely. So there's a lot of times where there's surprises, twists and turns where, we need to come up with a estimate of accounts receivable because they're a cash basis, and they need that for their net working capital peg. And guess what? We need it tomorrow. So that's something that, we've learned to become nimble and adept at. And as I mentioned at the beginning of this, my team in particular, we have some folks in India that support us. So we kind of have a 24-hour work cycle going on that really helps us meet these really pressing deadlines, and deliver really high quality work.
The analysis that you do, in terms of coming up with what is a reasonable adjusted EBITDA number, does it go past that to actually making a recommendation and valuation? I.e., do you also get involved with the multiple and what that should be, or is it more everything else, but pre-multiple?
Yeah, we don't get involved with the multiple. Kind of our role is to be kind of that independent third party, disinterested whether the transaction happens or not. We're just trying to say, here's what EBITDA is, and then from there you can value it.
I'm super interested in the next question. Historically, right, it was the buyers who used to request the financial due diligence to get done. That just makes sense.
Yeah.
Why should a seller consider getting a QoE report? And are you seeing that happen more and more in the marketplace?
Yeah. So as you mentioned, it's almost a requirement for if the buyer is going to be seeking lending, you can almost, you can almost bet that they're going to be getting a QoE. And if the buyer discovers something in the QoE that is accretive or value add to EBITDA, they're probably not going to share that with you. That's going to be an upside that they know about for their clients. So that's the first thing I'd mention is if there are things that are additive to EBITDA, if you're not getting a sell side quality of earnings, you may not uncover those sort of things. So it also it's a good dry run to what the buy side QoE is going to look like. It gives you practice. It's a prep with a friendly party. It helps for a faster close. It makes all of the offers that come in before, pre-LOI, more informed and less likely to have purchase price adjustments. There's just a lot of benefits of doing that. And over the past 10 years, I would say we're seeing it a lot more. I'm doing probably 50% of my work is sell side, maybe 60%. It's every year. Yeah.
I just think it gives the seller a chance to control the narrative, right? Around their company. Understand their numbers, explain them, put the stories behind them to help the buyer understand them, understand what your strengths are, what your weaknesses are, present them in the best light possible. When I was a consultant at KPMG, I used to always love writing the statement of work myself because that allowed me to control, the narrative for the project, what the scope was, et cetera. And I think this is similar feel to it. You get to control the story before somebody else comes in and writes their version of your story. How far ahead? So let's say an MSP is thinking about doing an exit, maybe this year, but most likely 2 years out. When should they do this piece of analysis?
So I'm going to argue that earlier is better. So just giving yourself time, especially if you know that, hey, I've been recognized as on cash basis for the past, since the existence of the company, maybe just having time to address any issues is really important. You don't want to rush through at the end and try to solve something on the fly. That can stall a deal last minute. So I think, we have a lot of sellers that, are thinking, hey, I might go to market in 6 months or a year. And they go ahead and get a sell side QoE now. And then we've got a blueprint in place that we can roll it forward right before they go to market. And it makes the investment banker's life easier. It allows you to get to market on time when you want to. Just thinking about doing it earlier rather than later is always helpful.
I'm going to ask this question. Good luck with answering it the way you want to answer it, but I want to ask it. How much should an MSP owner budget for sell side QoE, and is it different from a buy side engagement?
Yeah, I mean, I'd say the cost generally isn't materially different between buy side and sell side. However, you probably see sell sides run a little bit higher on average, just because you're bringing in external accounting help to help with various aspects of this transaction. We're going to help with the purchase agreement if you want us to. There may be a roll forward. There's just a lot of areas that if you haven't done a lot of transactions, it's nice to have an accounting advisor by your side.
And what does that include as far as a packet that you deliver to the client? What are some of the key deliverables in there?
Yeah, so if we're talking, there's really 2 levels of deliverables. We can have an Excel data book, which is all of your financial information presented in one massive Excel file. I mean, we probably end up with 40 to 50 different tabs of information by the time we're done. It's going to have your financial statements. It's going to have the quality of earnings table that I've talked about. It's going to have supporting tabs for every adjustment that requires that. We'll have an adjusted income statement where we take all of the adjustments and we bake those into the reported financials and show, here's what your P&L would look like had all these one-time unusual events not happened. So that's one level of deliverable. And then there's a second tier of deliverable that a lot of people on the sell side do, is what we call our full report. It's really a 50-ish page PDF that takes all that Excel information. We summarize it in a PDF report. We put narratives around the accounting policies, the trends, more full narratives around the adjustments and changes over time, and whatever other analyses make sense for your company. We're doing a lot more narrative type approach, so that if you have 10 different companies looking at you and the founder doesn't want to answer the same accounting questions 10 different times, having this report where everything's summarized in one place really saves a headache for the owner.
So for the numbers that you shared with us, does that include the Excel, the PDF report, and the net working capital analysis?
Yeah, so the PDF report will make it run a little bit higher, but yeah, that's all of it.
That's all of it. Okay.
Yep.
When you've done that work and you hand it over to the client, do you have a session with the client to explain everything that you've done there, or you sort of leave it to them to absorb the information themselves?
No, we actually encourage feedback and the client's review too. We want, we don't want it to be Weaver's view of your business. It's a collective view together. So we certainly solicit feedback from the client. Now, if we're on the buy side, we're not going to be sharing any of that information with the target company. So if that report is for our private equity client or our investor.
Yeah. What are some trends that you're seeing in diligence, like from the perspective of the technology that you use to assess a company, even from the perspective of like, is it taking longer to do financial due diligence, or are buyers asking for more information, or some of the trends you're seeing?
I think one trend that we've touched on is just the proliferation of sell-side due diligence. More and more people are seeing the value in that and how it really smoothens out a transaction. So that's been a trend that's really grown, kind of the demand and the market for QoEs. Other trends, I mean, just technology in general, like we're kind of at the forefront of AI. And how is that going to shape and change what we do? So, there's a lot of things that I think are kind of on the horizon, but we're just kind of starting to get into some of that fun stuff like AI.
Yeah. And, just to keep things real here as well, like financial due diligence is one very important piece of the overall due diligence. You're going to get due diligence, you, the seller, are going to get due diligence around the quality of the relationship that you have with your clients. So like client satisfaction, employee satisfaction, key employee personnel. And so much of that information can be gleaned through social media and social posts, right? So I really think that AI tools can become particularly useful for buyers when they're reviewing your presence in the overall marketplace and how does that go down. So I think that that's another area where you might see AI tools really sort of quickly gathering a lot of information about a particular seller to see if there are any red flags, that the buyer should be aware of. So this is something I think that sellers should be
Yeah.
aware of themselves.
No, that's a great point. I mean, we've focused our conversation today on financial due diligence because that's what I do. And we are typically kind of the first diligence stream that kicks off.
Yeah.
Because if a buyer and seller aren't on the same page as to what EBITDA is, it's very hard to come to terms on a deal. Yeah. But Weaver, we do tax diligence, IT diligence. Every firm's going to do a legal diligence stream in addition to all the other diligence streams that you mentioned. So there's a gauntlet to go through as far as diligence is concerned when doing a transaction.
Yeah. A buyer shared a very interesting point with me. He said one of the first things he looks at is he goes into the the seller's LinkedIn profile, looks at their employees to see whether the employees are listing themselves as members of that same firm or still listing themselves as members of the firm that they came from, to get a sense for how integrated the firm truly is. Is it really a cohesive unit of people, or is it being cobbled together as different brands so existing inside of it? So
yeah,
I think those are interesting qualitative things that sellers should really bear in mind. I think we touched on this question, but I'll just put it up here again, which is, how far ahead in time should MSPs be looking to get this done? I mean, it's not unusual for me to hear MSPs saying, I'm 5 years away from exiting. I mean, do you think that's still worth it at that time, or is that too early? Because those can change.
Yeah, that type of time horizon, I would say just be thinking of getting some accounting processes in place now. If you need help from an accounting perspective, invest in that. Mm-hmm. It's probably a little early for a QoE to be meaningful. I would say the QoE, if you're thinking in the next year-ish, that might be kind of the maximum horizon. But before that, certainly investing in accounting, all of that makes a lot of sense to make the QoE and the transaction go a lot smoother.
Look, we're living in a world where so many things are getting automated. Things that we never thought would get automated are getting automated. And so much of the work that lawyers are doing nowadays in terms of reading documents and comprehending documents and things are going the way of AI. Not that it's happened already, but certainly like we see trends in that direction. Do you think we're going to be in a world where financial due diligence is going to become a push button thing where you have a tool like you mentioned which draws information from QuickBooks and churns out a report?
Yeah, I mean, I don't see it yet, but I have been blown away with just the advancements of AI. But I think we will get to a world very quickly where the data is ready to be interpreted very quickly. So, but you're still going to need someone who has that experience, has that context of why am I doing these things, at least for the foreseeable future for me. So
what I thought might happen here is you might get 80% of the way there, right? With the tool. But what will happen is then the human being will still need to be there for the remaining 20%, and all the attention will get focused on that 20%. So it'll become very, very important to provide useful insights, on that 20% that needs to get customized to the specific business that whose problem you're trying to solve. So it'll become about quality of analysis and insights in a particular industry. But I think you're right. We're still a little bit further away, on the automation of this stuff compared to some of the other sectors. Any final tips for MSP owners that are thinking about M&A or navigating the financial due diligence process? What are some key lead behinds for that?
I'd say final tips, just realize that there's always going to be surprises or issues to work through to get a buyer comfortable. I think being flexible as a QoE, like I mentioned, QoEs are just as much an art as they are science. So it's normal to have to work through a couple key issues. So don't feel like that is a blemish on going to market if there are a couple things that we need to work through. It's very normal. And so just being patient and comfortable that, we can solve those issues is something that's helpful.
Dan, thanks so much for joining me today to talk about this really important topic. I really appreciate your taking the time to do this with us, and I hope that going forward we can do a few more of these guys.
Yeah, I had a great time here, Matter. So thank you for having me.
Absolutely.